Everybody, this is part 7 of my multi-part series on Tesla's 4Q 2024 estimates. Let's dive right in. So now we reached earnings per share, and here again important, earnings per share is abbreviated EPS, obviously. This is a diluted metric and non-GAAP. So diluted means we account for all dilutive instruments outstanding, not just basic shares outstanding. This is very important. Whenever you do any kind of valuation work, you always want to do it on a diluted basis because you want to capture all claim holders of equity cash flows. That's the core principle behind it. Non-GAAP, as we discussed earlier, non-GAAP captures one-off items, accounts for the effects of share-based compensation, as we discussed earlier. So this is the primary valuation metric in most stocks. But however, this can vary in different industry. But we're not going to get into this in this series. So and then when you look over here, how do you calculate EPS? It's very simple. You take the adjusted shareholders net income that we discussed earlier and you divide it by the diluted number of shares outstanding. This is often abbreviated as NOSH. And then when we look up here, you see like the bottom of the income statement. So you have total net income, you take out non-controlling interests, you get to shareholders net income, you add back share-based compensation, you add back other one-off items. Typically, people just use what the company adds back, but as an analyst, you have also the freedom to adjust for other things that you believe are one-off, and you calculate the adjusted shareholders net income. In this case, or in my Tesla forecasting, I just go by the company. I do not make additional adjustments because this always adds a significant element of subjectivity. And then you have to have the diluted NOSH, and the diluted NOSH, you simply add the basic number of shares outstanding. You add back all the stock awards and other dilutive instruments. For example, there are certain types of debt, typically called hybrid debt, which could be dilutive. And to calculate their dilutive effect can sometimes be a bit tricky. But the important thing to remember is the typical adjustments you should make are readily disclosed by Tesla. So this is not something you have to mess around with. So you can literally find directly in Tesla's disclosure diluted NOSH. So you take these metrics, divide one by the other, and this gives you then the earnings per share on a diluted non-GAAP basis. So keep this in mind. Excuse me. So that then you can see here how this metric developed over time. So we have seen some significant peaks over $1 per share in end of 2022. I warned at the time that the margin Tesla had at the time were unsustainable because here the global auto market was driven by significant one-off effects. Most of the market, like traders and people that are not non-auto expert investors, they didn't realize that what happened here in this period was a complete one-off effect and was unsustainable. And without going too much into detail, it had to do with COVID. COVID caused a supply shock globally. Lots of shutdowns. Millions of vehicles weren't produced, while at the same time there was a relatively healthy demand for vehicles after the poor 1Q, 2Q in 2020. Then there was also significant move by some consumers to shift to personal transportation from public transportation. There's a long story, but anyways, there was a robust demand, not enough supply, and this then, in addition to a general increase in inflation, drove skyrocketing vehicle prices, simply because one, inflation, but also because automakers could charge a lot more for their products, and it's their duty to their shareholders to basically charge as much for their products as they can, and so they did, and Tesla obviously was no exception. And so Tesla prices were quite high, led to very high margin for a mass market product, and in the near the 30% range, and this was never going to be sustainable, and that's why obviously this had to come down. And keep in mind, at this time, Tesla's business was almost entirely autos. Here was still significantly autos, although energy storage in this period already moved into a positive territory. Here there was more loss. Was not really a needle mover back here. And then we had around 4Q 2020, we saw first signs of significant price was starting in the global auto industry, and they just continue to intensify, and well, and then 4Q was likely, sorry, 1Q 2024, 1Q this year was likely the bottom with the significant 1Q deliveries missed that I explained earlier. So, and that then gets us to the forecast. I forecast for Tesla 76 cents per share in the fourth quarter of 2024. This is significantly down from my prior quarter. The primary drivers are really the significant drop in ASP. This significant drop in ASP is driven by uh, much less one-off revenue recognition, um, significant incentive, which include significantly more aggressive leasing rates, significantly subsidized financing rate, this on a global scale for the full quarter, not just mid or late quarter. Various other incentive schemes, such as very attractive sort of referral programs, also on a fairly global scale, not in all markets, and in addition to inventory discounts, and then there were even some other smaller initiatives on a local basis. Long story short, this, in addition to the slight volume miss, uh, drove sort of the significant underperformance versus my October 2024 expectation. However, I think I'm not alone in that. A lot of analysts had to revise down their EPS forecast, as far as I know. For example, the latest consensus is actually almost exactly in line with mine. I think current consensus, what I've seen, is at 75 cents. So I'm slightly above consensus right now, and I always beat consensus, so that there's potentially a slight upside to consensus. Although I should caution that if consensus is 75 and Tesla delivers 76, it's not going to do much because the stock trades at a very high PE ratio, and to move this huge market cap needle, something more has to happen. So I think at this point, this is it's now sort of after first week in January, roughly. I think most of this is baked into the stock. So the call in about a little less than 3 weeks for Q earnings call will be mostly about the outlook of 2024, sorry, 2025, the launch of the new vehicles, the anticipated launch of Tesla's ride-hailing network in the US, and on a small scale at least. So, and then just some more explanation. So if you look at here at these colors, so here's the adjusted earnings, 2.67 billion. The NOSH data estimate, this is also a bottom-up calculation, and you just divide this by that number, gets you to the 76 cents. And here have the implied growth rates. We discussed this earlier, so 7% sequentially, so compared to third quarter, and then 7% also compared to the fourth quarter of 2023. So with that, we are about to leave the income statement. So in every company you have three main statements, which is the income statement, the balance sheet, and the cash flow statement. And the real story of a business is really in the cash flow statement. So now we move on to the cash flow statement. And here you see how it breaks down. You typically, I mean, there are other ways how you can do a cash flow statement, but the global standard and 99% of cash flow statements I ever saw have been structured in this way. You start with the net income from the P&L. So basically, you start from this line up here, and then you add back various items. Then you subtract certain items, and then you get to the first of three main components in the cash flow, which is the OCF, or operating cash flow. Then you look at the sort of the investment activity. This, in Tesla's case, this is investments in AI, factories, equipment, tooling, and so on. And then, but then also how much cash Tesla invests in, for example, short-term investments that we discussed earlier. This would be a deduction. And then you calculate and the net result of that investing activity would be the investing cash flow. And then the third component of the total change of your cash flow is the financing cash flow. So what you do at the end of the day is you look at, okay, how much net operating cash flow was produced, how much net investing cash flow, how much net financing cash flow. You add everything together. The sum of it is the change. So then you look at, okay, what was the cash of the beginning of the period, to which you add the change, and this then gives you the cash position at the end of the period. And then on the cash flow statement, you can calculate the most important metric in a company, which is the free cash flow. And there are different of kinds of free cash flow. This is not the free cash flow people talk about when they talk about valuation. This is um, they are related, but there are some differences. I will not go into it, but free cash flow, as it's defined here, is a key metric, but it's not the free cash flow that is typically used when people talk about valuation. But I will cover this in a future episode probably. And the free cash flow is calculated by taking the operating cash flow, and then you typically subtract in the capital expenditure. They're almost always negative. There can be some situations, but I'll discuss this in another episode, where it can be positive, but this is like an extreme outlier case. So you have always the operating cash flow, which can be negative, by the way, and you add to this amount the capital expenditures, which is a negative. So it reduces. So let's say operating cash flow is 100, capital expenditures is negative, let's say 70. So you would be left with a free cash flow of 30 in this example. And this is the reason why we start on this slide with operating cash flow. And later we will go into some of the key drivers. And I expect that the operating cash flow comes down a bit in the fourth quarter after the exceptionally strong third quarter. And you can see it here. Tesla delivered almost 6.3 billion, and I estimate it comes down to 5.6 billion. So to just keep these two numbers in mind, 6.3 billion and 5.6 billion, because here you have like a change analysis. So here you have the 6.3 billion from the third quarter, and the 5.6 billion of the fourth quarter that I project, and this is the 2Q actual, which was 3.6 billion, and this bridge shows you not the absolute amount of an item, for example, payables, and I will discuss in a second what payables are, um, but the change in the cash flow statement, how the impact changed. And you can see that, for example, in when we moved from 2Q to 3Q, where we had this very high operating cash flow, payables were by far, you can see here on the bar, by far the biggest driver. Net income added a fraction of the increase. Um, and then you have a bunch of other items that are not that huge, a needle mover. And then here you also some headwind compared to 2Q. For example, the headwind in the third quarter was that there was a inventory buildup after there was a significant release in 2Q, and then there was a smaller amount. Sorry, there was a larger amount of prepaid expenses. So the way this works is when you have an increase of liabilities, it's a good thing for the cash flow statement. Basically, the way to think about it is you incurred a cost, um, but you haven't paid yet. So you have an increase in liabilities. But then also on the flip side, if you earned something but haven't received the cash yet, that would be called receivables. If they go up, that's a cash flow negative. For example, let's say you sold a car, you booked the profit, it goes into net income, but the customer hasn't actually paid you yet. But let's not get into why. But you recognize that revenue. By the way, Tesla doesn't do it. Tesla only recognizes, for example, vehicle revenue when a car was fully transferred to the customer, and the paperwork is all in Tesla's hands. But long story short, let's say you sold a vehicle, you recognized all the revenue, all the profits. So that car is reflected here, so the net income goes up, but you did not receive um, the money from the customer. Then this item, this is an asset, uh, this item goes up, um, receivables. So I put it here, you weren't paid yet. And increase in receivables is a cash flow negative, because again, you accounted here for the profit, but you did not receive the money. And in the cash flow statement, you try to get from the accounting net income to the cash income, let's say. And that's why you need to adjust for all the non-cash items that you accounted for here in the net income. So the net income is kind of inflated and at the same time deflated by various items. For example, the net income is reduced by the amount of depreciation. However, the depreciation is an old, like usually from mostly from many quarters ago, cash outflows. So there was no cash outflows, but there is a deduction for depreciation that sits in the net income, so that reduces the net income. So if you want to know the real cash flow in that quarter, you need to add back this let's call it notional deduction. The same with stock-based compensation. You need to add it back. So stock-based compensation was deducted from net income, but there is no cash outflow against that item. Same with write-downs. Write-downs are just accounting adjustments for something where you have indication that the value of something went down, but writing something down doesn't mean there's any cash lost in the business. Um, and that's why you need to adjust for that. So this is all part of the add backs. But then conversely, you have items that you did not reflect in the net income, which did result in a cash outflow. And for example, if you produce more vehicles than you delivered, the higher production is not reflected in the net income, but you paid for it. So that's why you need to deduct for the cash of the that is bound in the increase in inventory. And then analogously for all the other items. So when we now jump back to sort of the forecast, so what happened in 4Q based on my forecasting? One, there was a huge inventory positive. This has to do with Tesla selling down. We dive into this in very much detail in a bit. Sell down a record amount of vehicles. Tesla's production fell short of deliveries in the fourth quarter by 36,000 units. And uh, on top of that, there were other effects we will discuss in a second, but that was the main effect. Then you have a bunch of smaller items, and then you have a negative in payables. And I'll discuss in a second why I think payables create a meaningful headwind in the fourth quarter. And these were really the main drivers. And this gets us overall to a slightly lower operating cash flow. And you can see that payables really created a big headwind. And the reason why it was is since the significant benefit that we saw in the third quarter was simply not sustainable on an ongoing basis sequentially. But we will dive into this in the next part. So this video is already quite long now. I stop here, part 7, and then I see you in a bit in part 8.